I've asked quite a few people about this ETF that we're talking about today. And a lot of people that I've talked to, they're not familiar with this thing, which is interesting because this ETF has beaten VOO, and it's beaten like the Russell 1000 ETF IWB, and that's over the past like 3, 5, and 10 years. But on top of that, it has beaten QQQ the past 3 years and the past 5 years, and it's essentially about the same as QQQ over the past 10 years. It's just interesting a lot of people haven't looked at this ETF considering its track record. The name of this ETF is the iShares Russell Top 200 Growth ETF. The ticker symbol is IWY, and even though it's called the Top 200 Growth ETF, there's not 200 stocks in this thing. What we'll do in this video is, first off, we're gonna compare IWY to the ETFs that a lot of people are familiar with. So this will include QQQ, the NASDAQ 100 ETF, VOO, the S&P 500 ETF. We're gonna throw in IWB because it's pretty comparable to this. IWB is just the Russell 1000 index. So think of the S&P 500, the 500 biggest companies, the Russell 1000, it'll be the 1000 biggest companies. We're gonna go through my ranking process, how I rank these ETFs. At the end of that, you're gonna see a clear winner that I'm gonna tell you which one I think is the best. Now this is based on the methodology I created for myself, and I'm gonna show you my free web app that will do all of this for you just with the click of a button. Okay, fine. It's more than one button. It's maybe like 4 different clicks, but it's pretty quick. And then we're gonna compare this to some other really popular ETFs that are more growth-oriented ETFs. So that will be SPYG, SCHG, and then even SPMO. And then finally, at the end of this video, you're gonna figure out, is IWY really as good as it sounds? Now we start this whole thing by understanding how this ETF works. I've condensed this into 6 steps. There's more. I'm just making this simple for a quick YouTube video. So what we have first, 1,000 stocks is the Russell 1000. Think of the S&P 500, the largest stocks based on market cap or how big the stocks are. There's 500 of those, S&P 500, Russell 1000, same kind of thing. It's just there's 1,000 stocks, so there's more smaller stocks in it. There's some mid-sized companies maybe because the first 500 are the biggest in the S&P 500. The next 500 are in the Russell, so they're gonna be a bit smaller than the first 500, right? And then we're gonna have 200 stocks that are in the Russell 200. Now the Russell 200 are just the 200 biggest stocks. So now these are bigger stocks than the S&P 500. So we went from 1,000 stocks down to 200, and it takes those largest 200 stocks, and there is a process that it goes through. The first thing is there's a high price to book metric that they use. Then there is a high sales per share metric and also a high forecasted earnings per share growth. And so it takes these 3 factors and it just creates a growth score. So all these 200 companies, they get growth scores, and then that growth score is multiplied by how big the company is, the market cap, and then everything that is in the top there, they end up as the top 100 to 120-ish stocks that are in IWY. A few things that are interesting. Number 1, this doesn't have a set number of stocks. Like it doesn't have to have 100 stocks. This thing could dip down. There could be 90 stocks in it. There could be 120, 130, whatever. It just takes this methodology and it picks the best of those stocks. For example, like there might be stocks in here in the Russell 200 that end up being like value stocks. Like they're not gonna make it into this because they would have more value, quality type of scores, so they wouldn't make it in. This is a growth ETF, so it's gonna invest in growth companies. Hence, those 3 things that they're screening for to create the growth score. There's different criteria that I use to rank these ETFs. So first we're gonna go through expense ratio. When we have the expense ratio, VOO of 0.03%, it's got the lowest expense ratio out of all these ETFs we're talking about. IWB, which is the Russell 1000 ETF, has a 0.15% expense ratio, so a lot more than VOO, but still not a very high expense ratio. Then we're getting up into the 0.20% area, and that's where an ETF like IWY sits that we're talking about today, and QQQ. So it is a bit more of the expensive side on the, let's say, super cheap ETFs, but it still is, 20 basis points, 0.20%. For a growth investor, this passes my test. Not for a passive investor who just like wants to buy the market and just wants the cheapest ETF. That's a different type of person. This would be maybe a person who's really interested in just growth. So if you're chasing growth, you want that factor, growth factor, well, maybe you're okay with paying a 0.2% expense ratio. Next up here, you have yield. So this has the lowest yield out of all the yields we're talking about today, 0.36%. QQQ has a higher yield. IWB, VOO have higher yields. Yields aren't very important right now because we're talking about growth investing, but just so you know, the yield is low. Now let's talk about risk. Of course, this is one of the most important parts, if not the most important part. So let's talk about the max drawdown. So for the max drawdown, going back to September of 2010, what we do is we say, okay, from a peak, when a stock hits a peak, to a trough, how far does that thing fall? This could be over a 1 month period. This could be over a 5-year period. We're saying the maximum amount that it fell, how much was it? Now, interesting results here. IWY had the best result. It fell the least. Now, it still fell quite a bit. They're all kind of similar here, but negative 32.69% for IWY, while VOO had a negative 33.99%, IWB negative 34.60%, and QQQ with negative 35.12%. So this thing performed well in terms of max drawdown versus these other ones. Maybe a positive for its risk assessment, right? Next up, we have volatility. Volatility, we have VOO with the least volatile, it's 15.81%. We have IWB coming in next at 16.08%. And then we have IWI with a 20.34%. So yes, it had the better max drawdown, but then it has more volatility than at VOO and IWB, but it is a slightly less volatile ETF than QQQ. Dividend stability is something that I talk about with income investing. We're gonna skip it. We're gonna go over to the diversification, or how many holdings there are. So QQQ has 101 stocks in it. IWI has 114. So similar amount of stocks to QQQ, more concentrated like QQQ. Not super concentrated, there's still over 100 stocks in this thing. But then if you have VOO, for example, 507 stocks, of course, a lot more. And then IWB with over 1,000 stocks. Then we have size. So remember when I said like no one knew about this thing? Well, I think it is apparent that not a lot of people know about this thing. So 16.4 billion in IWI, that's not a lot of money comparatively to, for example, IWB, which has 43 billion in it. And then we have the giants, we have QQQ, $385 billion inside this thing. And then we have VOO with $1.4 trillion in it. So less money in this thing, even though, the returns have looked pretty good. And speaking of returns, let's talk about it. How did IWB do over the past 3 years? It had a 23.36% return. That's IWB, that's the Russell 1000 tracking ETF. A good return over 3 years, obviously. I think anyone would be happy with more than 20% in an ETF or any investment. That sounds great. But then when you compare it to the other ones, you're like, okay, well, VOO, very similar, slightly better. And then you got QQQ in the 31 area, and guess what? That means IWI had a better return than 31.65%. So its return is 31.83%. Now that's over 3 years. Let's look at 5 years. We have IWB again, 14.87% over 5 years. VOO, 15.55%. We have QQQ, still not number one here, at 16.44%. And then we have IWI coming in at 17.47%. So over a percent better over 5 years than QQQ. Pretty interesting. How did it do in the 10-year? Okay, 10-year. Again, IWB, 14.22%. VOO, we have 14.59%. But then we have, which one is it? QQQ or is it IWI? So we got IWI coming up, 19.08% return. Very good return. Obviously, over 10 years, if you could get that return, you'd probably be very happy. And then QQQ with 19.64% return. So phenomenal returns. I mean, let's be honest, phenomenal returns for all these ETFs. If you're not happy with a 14% return over a 10-year period, you're probably, really, really shooting for the moon. But when you can get up to that 19% level, I mean, I would hope you would be very happy with that. Then we have just how much 10K would have grown to. So, we like to see real numbers sometimes. Just percentages, they're not the easiest for us to kind of wrap our heads around. So if you had $10,000 and you had IWB over 10 years, you would have grown it to $37,718. VOO would have been grown to $39,034. IWY would have been $57,331. And QQQ would have been $60,093. Now, to show you what score this got, I will show you this graphic here. Now, this is based on growth investing. So you'll see there's a red column here. This red column changes depending on if you're a growth investor, passive investor, or a dividend / income type of investor, these are going to have different weights. Now the reason is because I weight ETFs differently based on the style of investing you're kind of looking for. So if I'm a growth investor, I care more about, if we look here, the performance, which is 0.40, we'll call it 40% of the score. And then I also care, of course, about the max drawdown and the volatility. So those things are also very important. You don't want a very high return, you want a return that is also okay risk-wise. It's worth the risk, in other words. And then I make sure that the expense ratio is kind of on there. Maybe like a super expensive ETF might not do as well. And then I want to have a certain amount of diversification, and I want it to have a certain amount of assets under management. I want super small ETFs, which all of these ETFs pass all of those, we'll call them like gates, right? So they all pass those, and you get this growth score. We want to see how this thing did, not just against those other kind of maybe broader market ETFs, but also how they do against growth ETFs. So we're going to do SPYG, we're going to do SCHG, we're going to do SPMO, which is a momentum ETF that's done very well. And before we do that, we're going to look at my web app that I created that you can try out for free. Now, what I do is I'm going to show you how this works with the ETFs we just went over, just to see exactly how it works. Then I'm going to show you those growth ETFs first. So what you do is you hit growth first because we're looking at this through a growth lens, and then we're going to type in the ETFs, VOO, IWY, IWB, triple Q. You can hit enter or this add button, and then you hit compare. It does its thing. All those calculations I told you earlier, it basically calculates that and it ranks it based on those calculations, or the weighting that I just told you about. So the ranking is IWY, like I said, is number 1 inside this ranking. Now let's take a look. You can see all the returns, you can see the fee, you can see the ranking, and then you can go down here, you got a snapshot. Now if you wanted to just say, okay, I want to look at the volatility of all these ETFs, you can actually sort them by how volatile they are. So now we have the left side is going to be the least volatile, VOO, with 15.8%, IWB, then IWV, and then triple Q. So you can play around with this, you can search ETFs, you can try to rank them using the growth factor, or you can change it up and you could say, okay, I want to look at this through a passive lens. Now this works of course better if you're comparing passive ETFs, but of course VOO is a passive ETF. Passive in that it's got a very low expense ratio and it's just a lot of stocks that you would basically want to track a market. Now, let's move on and let's throw in the growth ETFs here and see how those do. So does IWY beat any of these other growth ETFs? So I'm going to keep IWY on here. I'm going to type in SCHG. So that's the Charles Schwab growth ETF. We're going to go with SPYG. That's the S&P 500 growth ETF. So take the S&P 500 companies and see which ones of those are growth companies. You're going to throw that in there, and then you're going to look at SPMO, and SPMO is going to take the S&P 500 companies. It's going to just rank it based on momentum. It's going to pick the 100 best for momentum score. And let's see, how does IWY compare now if we look at other growth ETFs? Does it still hold up within that factor? So after I click growth now, and we have SPMO is on top as number 1. So SPMO is showing a bit better than IWY. However, IWY is still showing as the second best one in this. It actually edged out SPYG and SCHG, which is interesting. I'm actually surprised SCHG didn't beat SPYG. Now we're going to look down a little bit further down and we're going to see what's going on here. But of course, we could see all the different returns showing SPMO having a 20% 5-year return. So beating out IWY in the 5-year and beating it in the 3-year. So the more current returns, SPMO has been doing better. However, IWY did better over the past 10-year return. And in fact, IWY had the best 10-year return out of all of these. So let's go down to the returns. We'll sort by return. And you'll see here, IWY at 19.1% had the best return out of all of these. For example, if you take a look at the volatility, SCHG is the most volatile of these, then IWY, SPYG, and SPMO, which is one of the reasons why SPMO really does so well. It doesn't have as much volatility as some of these other growth ETFs, but it still has returns that are at least equal to or better than those, which is why sometimes SPMO can do better in my ranking system than some of these other ones. The last thing I personally find pretty interesting is how big these ETFs are. So if we do sort by the assets under management, So on the left, the most assets under management are SCHG with 50 billion. So it's not a small ETF, but nothing compared to like Triple Q, of course VOO. Those are like the giant ones, but 50 billion is a considerable amount of money inside an ETF. Then SPYG being next, it's close to SCHG with 42 billion. Then you have IWY down there and SPMO, both lower. SPMO coming in number 1, interestingly, and IWY coming in number 2 here, yet they have the least amount of assets under management. I don't know, maybe something to think about. Do I think this ETF is interesting? Absolutely. It's got an amazing track record. It invests in large cap companies. If you're looking at that type of style, if you are just a strict growth investor who only wants to invest in the growth, let's say, factor, and you want larger companies, well, then this thing has done pretty well. If you want to try out this web app for free, take a look in the description below. And I've talked a lot about SPMO in this video, but is there an ETF that I've reviewed that's better than that one? Well, take a look at my SPMO video right here.